What it is, y'all, Small here from the Gym Therapy Pod, and on this episode, we're going to be concluding our option trading series. So in this video, we're going to basically go down the list of everything we talked about in the previous videos and basically do a options trade or go through a checklist of what you should do when you're going into trading your first option. So we're going to go through a play-by-play of if you were executing an option or going to buy an option contract. And the company we're going to use is Apple. Pretty easy company, and we're going to use like imaginative figures. So step one, you want to find a company that you want to go ahead and do your research or technical and financial analysis on. And we're going to use Apple. And we're going to also just use, let's say WWDC didn't happen yet. And we're going to use that at a conference in a later portion of this example because we talked about that last week as well. So we chose Apple. Now we do our research on the company. We looked at all the financials, the balance sheets, the income statements, the 10K, the 10Q. Looked at everything. We've done more research to see that this WWDC is coming up within a few weeks, and we can anticipate that they'll be revealing, let's say, 10 new items that we're all going to be excited about, and investors and shareholders are looking forward to. And so, step one, we've done our research and we've picked our company. Step two, we go into whatever application you want to use. The one I always use and I want to recommend is Thinkorswim or TD Ameritrade. I'm most familiar with that one. But let's say we go into our app, we locate our ticker of said company, and I believe Apple's ticker is AAPL. So boom, we find that. So now we have our research behind us, so we know exactly what's going on and what's going to potentially happen at this conference. We have the company and we found the ticker. Now let's go into the option chain and figure out if we're going to, bet against the company because we feel like they may not do well, or going to go with the company because we feel like they actually are going to do extremely well. So now we're going to decide, hey, are we going to do a call or we're going to do a put? In this case, we're going to do a call. And Apple, let's say, is only trading at $100 per share. So after we figure all that out and say, hey, we're going to do a call option on this particular company, now we want to see what our strike price that we're going to go to and what our expiration date is going to be so that we can make the most in terms of our profit for this particular option call. So as the company is only trading at $100 per share, we're looking at different strike prices, 105, 110, 120, 130, 140, so on and so forth. And again, like I said in my previous videos, you want to buy either in the money or as close to in the money as possible, whether it's a call or a put, because it gives you the best option in terms of profit if that company does go up, because it's not likely that a company goes up $40 to $50 or 30-40%. But in the case that does happen, we're still close to that particular share price in terms of our strike price. So let's say we chose a strike price of 105 and an expiration date 2 weeks out. The conference is next week. So as we're gearing up for the conference, we're doing more research on the company, looking at the stock value. So now it's trading at $105 per share. So as we're leading up to the conference, people are buying more and more into the company because they're like, hey, we want to get a piece of this before the conference comes because we see the value is increasing. So let's go ahead and buy into that. The whales are buying into it, or the big organizations are buying into it, so that once the conference is here or over or whatever the case may be, they can go ahead and have a major sell-off and profit in the shorter term. So now we know that the company is trading at 105 per share. Our option call is now right there in the money. Let's say it goes to 106. Now we're like in the money, and we're a week out from the conference of their presentation of their new items. So let's fast forward, and we have our expiration date, we have our strike price, we have our particular company, we've done our research, and the only thing we're waiting for is for the event to happen to see if they can actually deliver on these 10 products. Now we're here. Let's say we're 2 days out from the conference, and our the value of the company is now, or the company is now trading at, let's say, $125. Now we have to make a decision like, hey, do we want to keep our particular call option because the value is at 125 and we had a strike price of 105, so we've obviously made a lot of profit? Do we want to sell that particular option call and take our profit and hold it, or do we want to wait until the expiration date or exercise the option to buy 100 shares of Apple at the $100 price in which we 105 price, the strike price in which we purchased it at, although it's trading at $120. Now, let's say the conference is happening, the stock value is still growing and growing. Let's say it's $140 now. That same question we had, do we want to execute our option call and take the profit now, or do we want to wait and then buy those 100 shares at 105 and then sell them for 140? And so now we have a decision to make. The decision is up to you and what you want to make in executing this particular option, but I would personally probably take the profit of that said option contract, because historically what happens is after a conference or even after like a great earnings call or whatever the case may be, after it rises in value so much, it can decline a little bit and you can lose out on the particular option call, right? And so you want to maximize your profit and use that money to reinvest that into, let's say, that company or another company or whatever company you want to go into. And so after that's all said and done, you made your decision on what you want to do. Now the process of buying your option is complete. So what we've done is we've done our research. We figured out what company you wanted to get into. We located the ticker of that company. We saw what the strike price is. We located that. We picked our expiration date, and then we either executed our option and sold for profit, or we waited till our expiration date was over and then exercised our option call and bought 100 shares at whatever strike price that we had. And so that was a rundown of basically what we talked about in all the previous videos, but like kind of a rundown straight through and how to, or a checklist of what you can do when you're purchasing your option call. And in this case, we did a call option. It'll be the same exact formula if you did it for a put option as well. So again, gave you a rundown of how to basically buy your first option call, but please take a revisit of the last videos that I did. It breaks down every single step verbatim about what it is, so what actually your call is, what actually a put is, so on and so forth. So please go check those videos out from the previous weeks. And again, as always, I want to thank you all for tuning in for another episode of Tactical Tuesdays. We're always releasing content every single day, every single week, so make sure to tap in, follow, like, share, and subscribe to our YouTube channel. And I'm looking forward to seeing you guys next week on another episode of Tactical Tuesdays.